Again, this is the second part of the lecture for Chapter 3, Adjusting Journal Entries. We'll go ahead and get started with the PowerPoint presentation. So just like always, I will go to the lessons folders and pull up the Chapter 3 PowerPoint slides. So last time we talked about the need for adjustments. I want to point this out one more time to you. The reason why we need adjustments is because first and foremost, in accounting, we use the accrual basis of accounting. We don't necessarily care when cash is received and when cash is paid. We care about when revenues and expenses are earned and incurred. So last time we looked at the timeline, we looked at the accounting periods, and we said that right here at the end of every month, before we prepare the financial statements, we need to look at certain accounts and we need to make sure that those accounts are appropriately presented on the income statement and the balance sheet. So the whole purpose of Chapter 3 is to ensure the revenues on the income statement are presented when they're earned and expenses on the income statement are presented when they're incurred. On the balance sheet, we make adjustments to ensure that assets and liability accounts are represented at the correct dollar amounts. So for assets, we want the dollar amount to represent the unexpired portion of the asset, and the liability accounts, we want those accounts to show what the company actually owes suppliers, what the company actually owes employees, the bank, and anyone else who they might owe money to. So last time we talked about the revenue recognition principle. I'm not going to spend too much time here on that. We talked about the expense recognition or the matching principle, and then we looked at the framework for adjustments. So now I'm going to do a brief recap on deferred expenses and deferred revenues. I'm not going to spend too much time on the actual entries because we already looked at them last time. And then we will go back, not back, but we will go to Connect where we'll be working a few problems. All right, so last time we said that there are two large areas of adjustments. The first one is deferrals. Deferrals could be deferred expenses or deferred revenues. So when we're preparing a deferral for an expense, or when we're making a deferred expense journal entry, we need to be thinking prepaid expenses. So from chapters 1 and 2, you know the prepaid expenses are actually assets. The company purchases those assets ahead of time and they use them up over time. So prepaid insurance, prepaid rent, prepaid advertising, supplies, and all the long-term assets, those are examples of prepaid expenses. Again, the company must acquire, they must purchase the asset before they can use it. In a way, we are deferring, we're postponing the expense to some future point when the company uses up a portion of the asset. So it's very important, just like we saw last time, that we understand the original transaction. Without an original transaction, there will not be an adjustment. So last time we looked at all of these adjustments for prepaid insurance. The original transaction is actually when the company buys the insurance policy. We also looked at supplies. The original transaction is when the company acquires or purchases supplies. Again, without understanding the original transaction, we will not be able to prepare the adjusting journal entry correctly. So again, deferrals is one of the categories of adjusting journal entries. Deferred expenses is one of the type of deferrals. The second type is what last time we called deferred revenues. All right, so let me see if I'm missing something here. We talked about depreciation last time. We talked about deferred revenues. So let's go to connect. Now I reminded you what we're trying to do here with adjustments. So I'll go to our section in McGraw-Hill Connect, and I'll be working some of the problems in the in-class practice problem set. So I'll open this as a student. This is exactly what your view should be. If you guys want to work along with me, you're welcome to. And if you don't, you don't have to. So last time we actually we completed the accrual versus the cash basis of accounting. So we did this problem last time. What else did we do? We are not going to do this problem. This is pretty basic. So we will actually skip, we'll skip this problem as well, 3 and 4. And we are going to go to QS 3-7. And I want all of us to take just a minute. Remember what we talked about so far are deferrals. So having that in mind, take just a minute and read through the instructions here, and let's try to work this problem. Remember what I told you earlier, you will not be able to work the problems correctly and prepare the journal entries correctly unless you understand the original transaction. So let's take a minute, read through. Again, keep this in mind. These are deferred expenses. So I want you to be thinking prepaid expenses, and then we'll work on the problem together. All right, so let's look at the two separate cases here. On July 1st, the Lopez company paid $1,200 for 6 months of insurance coverage. You know that you have to be making a deferral or journal entry adjustment for deferred expense because the $1,200 for 6 months of insurance coverage is a prepaid expense. So if $1,200 is the coverage for 6 months, if we take $1,200 and divide it by 6, that would mean that every month the company will be using $200 worth of insurance. So if I need to pay attention to the dates, right? So they bought the insurance policy on July 1st. This is the original transaction. No adjustments have been made, and now it's December 31st. So July, August, September, October, November, December, the company hasn't made any adjustments. They have not shown how much they have used up. So in this case, when we prepare the adjustment, so here's our journal entry here. We need to record the year-end adjusting journal entry to reflect the expiration of insurance. At the end of December, the company has used up all the insurance. When a resource is used up, that would make it an expense. So I'm going to go through here and find insurance expense. Where is my insurance expense? Okay, so I need to, sometimes if you type, you get to the answer quicker. So I'll debit insurance expense. At the same time, on the balance sheet, I will credit prepaid insurance for the same amount to show that the company has used up every single penny of insurance that they bought in July. Okay, let's talk about this adjusting journal entry. I called it a deferral because this adjusting journal entry deals with prepaid expenses. This deferral happens at December 31st. So adjusting journal entries will only be prepared on the very last day of the period. One income statement, in this case, insurance expense account, will be affected. One balance sheet account will be affected. And when you guys are preparing adjusting entries, you have to be super careful to not include the cash account at all. All right, so this is actually pretty straightforward. Now, let me go back up here and show you the case again. They bought the insurance policy on July 1st. This is the original entry. When they bought the insurance policy, they prepaid for 6 months worth of coverage. If adjustments had been made and you only had to make it for the month of December, then the journal entry I just finished would have been for $200. Okay, let's look at B. So I'm going to go to the next transaction, record the supplies used during the year. Here's the next transaction. Zim Company has a supplies account balance at the beginning of the year, $5,000. So $5,000 is what they had available to use at the beginning of the year. They added to the $5,000 $2,000 more of supplies. So the supplies available for use during the year was $7,000, right? So $5,000 plus $2,000 is $7,000. As of December 31st, a physical account shows $800 is available. So my first question is, how can we figure out how much supplies were used? Well, and the first answer is, it's pretty simple. The company had $5,000 at the beginning, plus $2,000, they had $7,000 available. If I take the $7,000 and subtract $800, $6,200 will be the amount of supplies the company has used during the year. Again, this is another example of a deferred expense or a prepaid expense. At the end of the year, I have to show how much supplies were used by debiting supplies expense. And again, I'll try to type it rather than looking for it. So supplies expense will be debited, and I'll debit it for $6,200 because that's what I'm determining has been used up during the year. This is the income statement account, and on the balance sheet, I'll credit supplies to show that the company has used up $6,200. Again, by doing this, I am making sure that on the income statement, the appropriate expense is recorded. On the balance sheet, the appropriate usage is taken away from the asset account. And now in the asset account, we should have the correct balance of $800. Do you guys have any questions here? Okay. So here's my journal entries. They're complete and correct. I wanted to keep in mind again, constantly go back to the fact that these are adjusting journal entries, and they happen at the end of the accounting period to ensure the revenues, expenses, assets, and liabilities are properly presented on both the balance sheet and the income statement. All right, so let's look at the next one, unearned or deferred revenue adjustments. So this is another deferral. Remember last time we only talked about deferrals. This is the first time that we're actually looking at problems, but we talked about deferred revenues and deferred expenses last time. So just like I told you with deferred expenses, think of prepaid expenses. I'm telling you with deferred revenues to think unearned revenues. Again, you have to understand the original transaction in order to be able to prepare the adjusting journal entry. Here, we are adjusting revenues for revenues that have been earned during the period. So let's look at the first transaction. The Krug company collected $6,000 rent on advance on November 1st. This is the original transaction. When they collected the $6,000 rent in advance, they debited cash and credited unearned rent revenue. So let me remind you what exactly is unearned rent revenue. Unearned rent revenue is a liability. So it's a liability because at the time of the original transaction, the company has not provided any rent to the customer. So the tenant paid the $6,000 for 12 months worth of rent. Rent begins November 1st. So every month starting November 1st, the company will be providing $500 worth of rent to the tenant. If I take $6,000 and divide it by 12 months, I can see that $500 a month is what the company will be earning every month. So here is my journal entry. I am supposed to, what am I supposed to do? I'm supposed to record the adjusting entry for each of the following for the year ended December 31st. Okay, so December 31st, if you look at the dates, the company has provided the tenant with a space to rent for the month of November, right? And then the month of December. So remember how we said that each month I took the $6,000 divided by 12, $500 a month will be earned. So the adjusting journal entry for deferred revenue will be deferred or unearned revenue. Unearned rent revenue will be debited to show the portion that was earned, and then rent revenue will be credited to show that the company has earned that. Now, in this case, we're starting with November 1st. November is 1 month, December is the second month. So we have $1,000 of unearned revenue and $1,000 of rent revenue that has been earned. The adjustment again is for the portion of that unearned revenue that became earned in November and December of that year. Does anyone have any questions so far? If you guys don't have any questions, I'll look at the next transaction. The company charges $75 per insect treatment. A customer paid $300 on October 1st in advance for, I believe there is a question. Hold on just a second. So here is the question. How did you get 1,000 again? So for the previous transaction, Janelle, I took $6,000 The $6,000 are for, get my cursor, 12 months. So if I divide 6,000 by 12, $500 will be earned in rent revenue by the company per month. Occupancy began November 1st, so we have the month of November and the month of December, because up here we were told that we need to make the adjusting journal entries on December 31st. Does that help? Does it make sense? Okay. All right, let's look at the next journal entry, 2. So the company charges $75 per insect treatment. The customer paid $300 on October 1st in advance for 4 treatments. This is an advance payment again, right? This is deferred revenue. So at year end, so the customer prepaid $300. At year end, 3 treatments were provided for the customer. So again, we will debit unearned revenue, and I'm going to call it service revenue this time, because this is a service. Those pest control treatments are a service that the company provides. And then I will call service revenue the account that I'm crediting. So look at this now. At year end, they have provided 3 treatments. So I'll take the number of treatments, which is 3, and multiply it by 75. So at the end of the year, the company would have provided or earned $225 worth of services. Now look at what's going to happen to the unearned revenue. So the customer started with this prepayment of $300. Now we're saying they no longer have $225. For next year, there should be $75 left on the account for the 4th treatment. So again, this is an example of a deferred revenue. Deferred revenue or unearned revenue gets adjusted for the portion of it that gets earned during the period. Okay, do you have questions? If you don't have questions, I'll go forward, and if you do, I'll address them now. All right, let's look at the 3rd transaction. On September 1st, a client paid the company $24,000 cash for 6 months rent in advance. So this is very similar to the first transaction that we did. I'll take the $24,000 and divide by 6 months. So every month, the company will be earning $4,000 worth of revenue. Now, I know that the journal entry will be the same. I'm going to debit unearned rent revenue, and I'll credit rent revenue. Now the question is, what would be the amount? Look at when the payment happened on September 1st. So we have the whole month of September, October, November, December. At the end of December, 4 months of revenue are earned. So $24,000 divided by 6 months, the monthly revenue from the rent is $4,000. But remember, because we start on September 1st, we are earning 4 months. So I will take the $4,000, multiply it by 4. The debit and the credit in this journal entry will be $16,000. So what we're saying here is, by December 31st, the company has provided rent for $16,000, and unearned revenue, which again is a liability account, is decreased by $16,000 because the company has already provided the rent to the client, to the customer. All right, so this is unearned revenue. If you guys have any questions, please let me know. So that let's go. Oh, sorry. So these are the journal entries here. For those of you who are following along. Let's see. Are there questions? No. Yes. I can't see the question though. Would I write it on the whiteboard? Unfortunately, I cannot divide. I can't write on the whiteboard today. I'm having some issues with my computer. So I will just state it again. Jacob's question was, so we divide 24,000 by 4. My answer is no, we divide 24,000 by 6. So I can do it actually here. Here's the 24,000. When I divide it by 6, every month the company is earning $4,000, right? So we have September, October, November, and December, which is 4 months, right? So now I'm going to take the 4 months and multiply it by the $4,000. At the end of December, the earned portion is 16,000. Does that make sense, Lisa and Jacob? Okay, no problem. Lisa, did this help a little bit? Okay, perfect. All right, so let's see if we can work another problem. Where's my, there it is. So the next problem, I'm going to skip this one. This is pretty basic. All right, so the next problem is accruals. We need to talk about accruals here in a second. This is an accrual as well, so let me just find. Okay, so we need to go back to the PowerPoint presentation and talk about accruals first before we can work the next few problems. Let me just save my spot here. We just did this. Okay, so we'll be on QS 3-12 accrued expenses adjustments. I just wanted to real quick go over depreciation one more time. So I'm going to go back to this slide 20. And I know, and I apologize, I don't mean to sound like a broken record, but you need to understand this depreciation deal. It's literally just the deferred expenses that we covered, except for this goes with long-term assets. And we talked about it last time, but again, I want you to really think about it today and think about it from the perspective of prepaid expenses, and try to rationalize the idea of long-term assets such as equipment, buildings, cars, being prepaid expenses. So we don't explicitly call equipment, building, cars prepaid expenses, but they really are prepaid expenses because we buy equipment, buildings, cars, anything that's tangible and lasts a long time. We buy that in the past and then we use it over extended periods of time. So the way we show how much of that equipment, buildings, or cars is by showing depreciation, by calculating depreciation. So last time we talked about the straight line depreciation, and I told you guys in our future there's a whole chapter on depreciation. So the straight line depreciation is calculated by taking the actual cost of the asset and subtracting the salvage value. Once we do that, asset cost minus salvage value, that would give us the depreciable or the net cost of the asset, just like we talked about last time, which we divide by the useful. So last time we also talked about useful life. This is the period of time the company expects to use the piece of equipment or building, whatever it is that we're depreciating, and then salvage value, which I also call residual or scrap value. Let me see, I think in contrast to depreciation, do we ever adjust for inventory that goes up and, okay, so Okay, Dave, depreciation, let's break down your question in a couple of different parts here. So if the company has inventory, and that inventory becomes obsolete, or if it declines in value, we would absolutely adjust the inventory down. In accounting, we would very rarely adjust the value of anything up because we tend to be conservative. So we would write down the value of inventory becomes obsolete. Unearned revenue is actually not an asset, it's a liability. So let me answer Dave's question, and then I'll talk about unearned revenue. Unearned revenue has nothing to do with what Dave's asking. All right, Dave, back to your question. So inventories, we will write them down if the value of them goes down. In accounting, we hardly ever write anything up because we tend to be conservative. The only way to determine what the value of something is to sell it. So unless the company plans on selling a piece of land or a piece of equipment, we will never adjust those things up. Depreciation is really not a valuation. Depreciation basically is a cost allocation. Does that help, Dave? Yeah, it actually is very interesting. That's that's what I did for a living in Equitable, and it's interesting how we would do those studies to determine if the value of our assets deteriorated, so we can show impairment, but we would never bring the value up. All right, Aya, let me address your question. First and foremost, do not confuse assets and liabilities. Unearned revenue is a liability account. Unearned revenue is created when the company makes a promise to provide a service or to deliver goods to a customer. The reason why we debited unearned revenue is because when the company earns revenue, when they provide services and deliver the goods, they don't owe their customers anymore. So unearned revenue is a liability account. It decreases on the debit side. Now, depreciation is only applicable to asset accounts, and not just any asset accounts. It's only applicable to long-term tangible assets. So you need to go look at the accounts and make sure you understand which one is a liability and which one is an asset. All right, Jacob, for tax purposes, because you pay taxes on assets, to Dave's questions, no, not necessarily. So the reason why we would impair an asset is because, like I said earlier, we want to be conservative and we don't want to mislead our investors and creditors. We don't want basically to misrepresent anything, our financial statements. However, so we would write assets down to be conservative and realistic and our data to be reliable. But you're right, any kind of a write-off, any kind of a write-down will decrease taxes, but not on assets, on income. Does that help, Jacob? All right, so let's go back to the depreciation piece. We already talked about that. Maybe there's another question. Hold on. So to double check, depreciation is only applicable. Yes, we depreciate only long-term tangible assets. What do I mean by tangible? Can you guys tell me? What's a tangible asset? Car, absolutely. Cars, that's an example of a tangible asset. Buildings. So anything that you're expecting to use over extended periods of time, and it has physical substance, right? The only long-term tangible asset that does not depreciate is land. So make a note of that. Everything else will be depreciated. All right, so let's that was a good refresher of depreciation. We also last time we looked at this. We looked at how the original transaction will debit equipment, and then the depreciation expense and the accumulated depreciation. For the most part, in this chapter, will be pretty simple, and for the most part, they'll be given to you. So the depreciation expense, accumulated depreciation journal entry is on slide 27. So I'm going to scroll down. Last time we stopped right here on accruals. So I want to talk about accruals a little bit. So accruals, this is the second large category adjustments. We haven't talked about accruals yet. I'd like to tell you a little bit about accruals, and then we will go to connect and work on at least one problem before we part our ways today. Accruals, those are journal entries that ensure the revenues and expenses are reported in the correct period, even though the customer hasn't paid yet, even though the company hasn't made a payment to a supplier. So there's several accrued expenses that we'll look at today and several accrued revenues. So let's go ahead and get started with accrued salaries. So you guys, all of you who have had a job before, you know that the payday, your payday, and the end of the month do not necessarily coincide. So here's an example. Fast forward, they pay their employees $70 per day, $350 per work week, and they pay salaries every 2 weeks on a Friday. So when the year end, here's the year end. The year end comes, 12/31 happens to be a Wednesday. So on 12/31, the company has to close the books. On 12/31, they would not pay their employees for the 3 days the employees have worked in that year. We have to accrue for salaries. We have to state that the employees have worked, therefore salaries expense exists, and the company owes their employees salaries. All right, so this journal entry, salary expense, salaries payable, will always be the same if we're accruing salaries. We will create a liability. Here's the liability, salaries payable, and we will increase the correct amount of expense. So again, the reason of all adjusting journal entries, accruals included, is to make sure that the company accounts for every expense that they had to incur, every revenue they had to generate in the appropriate period. By adjusting accrued expenses, by accruing for salaries expense and creating a liability, salaries payable, the company now is reporting the correct expense on the income statement and the fact that they owe their employees $210. Now, in the future, on that Friday, or not the Friday, but the January 9th, which is the Friday after, when they pay their employees, cash will be credited, and then salaries payable and salaries expense will be debited to make everything be reported in the correct period. That's a very common accrual of expenses, salaries expense. Let's look at an accrued revenue, and then we'll go work a problem. So accrued revenues, this is something that you guys are actually familiar with. You didn't know it, but you are familiar with it. So accrued expenses accrued revenues are revenues that are earned in a period are both unrecorded and not received in cash. So earlier I said you guys know how to do this journal entry, because if you have a revenue that's not recorded or received in cash, you know that you have to debit accounts receivable and credit revenue. At some point in the future, when the company collects cash, then cash would be debited and accounts receivable will be credited, as well as whatever other revenue account we use. Now, the biggest difference between deferrals, the journal entries that we already learned how to prepare, and accruals is the timing of the cash transaction. For deferrals, cash happened in the past. For accruals, cash happens in the future. Okay, so let's look at Connect. So in addition to salaries expense, we will accrue interest, and we have actually 2 cases where interest will be accrued. All right. Let's look at A, salaries payable. At the end of the year, salaries expense of 15 has been incurred but not yet paid to employees. This is what I described in the PowerPoint presentation. So the journal entry for that would always be salaries expense, but for the whole amount, in this case, $15,500. We will also credit salaries payable because the employees have not been paid just yet, $15,000. So again, accruals are probably easier. We will always debit the expense account and we'll always credit the liability account if we are recording expenses. For accrued revenues, we'll always debit accounts receivable and credit revenue. So let's look at the next one. At its December 31st year end, the company owes interest. So if we owe interest, I know that the account that I'm crediting is interest payable. I'm owing it. I am not paying it. $250 credit. This is a liability account. And I have to report interest expense of $250, which is the exact entry of the accrual. All right, one more, and then we'll look at accrued revenues. At its December 31st year end, the company holds a mortgage payable that has incurred $875 annual interest. So the exact same thing, interest expense, $875, interest payable, $875. I think there is a question that I need to address here. So yes, for accrued expenses, we will always debit expense account. Yes. All right, so let's look at the next problem, which is, I believe, accrued revenue. So this is accruing salaries. You guys can do this on your own for practice. I'm looking for an accrued revenue, but I'm not seeing an accrued revenue. Hold on just a second. Nope, this is an accrued expense. Help me out here. If you guys see an accrued revenue, let me know. Oh, there it is. No, this is unearned revenues. That's not it. Okay, so accrued revenue, can't see a problem like that, but they're probably the easiest. So let's look at this example here in the book. Here's the accrued revenue. If the revenue is earned but not recorded, all you have to do is debit account receivable and credit the actual revenue account. So I told you at the beginning of the week that your overview videos are due today, and you have to work on your homework and submit it on Sunday. I am actually going to continue with chapter 3 on Monday after your homework and after you're a little more familiar. And just like we did with chapter 1 and 2, I will have extra practice problems for you that we will be working on that day. Hopefully, the IT people will fix my computer and I can use my whiteboard again. Do you guys have any questions about what we covered so far? If you do, I will address those now. And if you don't, have a wonderful, wonderful day.